I welcome our next panel. The topic of the panel is taxing technology businesses and transactions, case studies, country approaches, and OECD's interim report. And the ground was laid in this earlier session when we looked at the digital economy business from a transfer pricing point of view. This session will take this discussion forward and will touch upon the different aspects from the corporate tax point of view and what other countries are doing. And may I call upon all the panelists on the stage, please. Mr. Ajay Roti from Dhruva Advisors, Mr. Gianmarco Cotani, former advisor to OECD, Mr. Kamlesh Vashni, Commissioner Income Tax from the International Tax Team, Ms. Vijayashree Raghavan, Head Taxation VFS Global, and Mr. Hariharan Gangadharan. A big hand to the panel, please. Let me briefly introduce our panel moderator, Ajay Roti, and Ajay, then I'll leave it to you. Ajay is a partner with Dhruva Advisors. He's based in Bangalore. Ajay is a member of the Institute of Chartered Accountants of India and holds Advanced Diploma in Management Accounting from SEMA, UK. Prior to joining Dhruva, Ajay was a partner with KPMG and also worked with BMR Advisors. Ajay has considerable experience in corporate tax, transfer pricing, and international tax areas. He's also advised a number of large multinationals and Indian companies on a range of direct tax and regulatory issues. Ajay has advised several technology companies on strategies around setting up of special economic zones and has been instrumental in obtaining numerous SEZ approvals. Ajay, over to you.
Thanks, Amay. So next I would actually like to thank Kunj and team because they've really shaved about 10 minutes and saved that 10 minutes for us because I just wanted to set the context of what we are going to discuss. And I think Kunj and team have done much better than what we could in the 10 minutes that we'd allocated. So I'll just start off from where they left. So, where did this all start? The issue around digital economy, taxation of companies in digital economy, etc. Sort of started with a lot of tech companies making headlines for their perceived tax structures, which were viewed to be resulting in a very low effective tax rate, global effective tax rate, etc. And if you just look it up, and ironically, if you Google, you'll find things about Google, Facebook, Amazon, Apple, etc. And the list is long. This also opened up a debate on whether the concept of morality exists in taxation. Always it was thought that morality does not exist in taxation, and as long as you are within the four corners of the law and you are allowed to organize your affairs in such a manner that you are not violating any aspects or any legal aspects of taxation, then your structure is good and your taxation, whatever structures you have are good. In my personal view, tax is too important to be left to morality. And I think it has to have a good framework of the law has to have specific aspects which require how certain companies, certain economies, whether it's digital or otherwise, have to be dealt with. But it did open up that debate, and then you got into, is it restricted only to digital taxation, or is it Starbucks case, and so on and so forth. But the attention remained on digital companies, and in my view that's because two specific or two large aspects of tax allocation or rights of allocating taxing rights, which were the permanent establishment and transfer pricing, were both perceived to be ineffective in digital economies. Because permanent establishment was an extension of the rule to say doing business with a country, doing business in a country, and if you were doing business in a country with a presence, subsidiary, branch, agent, etc., you would have a physical nexus and therefore you'd be liable to taxation. And that got blurred in a digital economy. You had companies who did not need to set foot in a country but could establish businesses, could have businesses, market shares greater than companies who were present in the country. Then you looked at transfer pricing to say the traditional approach was to look at the functions, assets, risks, etc. Then you couldn't link what was happening in the digital economy space to assets or to functions. There could be no assets in a particular country, and then came the concept of value creation. Would you link it to value and so on? And that's where the whole focus on digital economy remained. It's not that these issues are there only in the digital economy, and OECD has time and again said that there's a difference between taxation of digital economy and taxing digitalized economy. And they're looking at taxing of digitalized economy and not really digital economy companies. But having said that, that's the backdrop in which OECD came back to say that this needs to be looked at holistically, and BEPS framework came in. And then you have 15 action items. I won't need to get into that. And it's not just coincidence that action plan 1 happened to be digital economy. It is one of the most significant aspects. So you had action item 1, which is really the addressing the tax challenges of digital economy. That again, highlighted the same point that I made just a while back, which is to say that it's impossible to ring fence the digital economy for tax purposes. You don't necessarily need to do something specifically for a digital economy. And then do you look at a digitized economy and you look at something which works across. Key issues that were identified again was nexus, data characterization. We've had a lot of discussion on this in the previous session, not really going to dwell on that. The final report on Action 1 came up with 3 alternatives. None of them recommended significant economic presence. Then gross withholding tax, which would be final taxation on those transactions, or a equalization levy. And countries were given these alternatives. None of them recommended, but one of the important things that was said was that you would need to respect your treaty obligations, and they have to be taken into account while you are choosing any of the options that you do. But what we are today seeing is a lot of countries calling it interim, or like Darpan said, interim measures, doing things which are not necessarily in line with treaty obligations or honoring them. And we'll get into some of what that would mean when we get into the panel discussion. And then it also discussed indirect tax measures, which is do you collect a VAT or a GST where applicable on those cross-border transactions. These were the things that were left, and then OECD said they would come up with a report specifically on the digital economy, and that's where the interim report came out. I will hand over the proceedings to Gianmarco, and the reason is he comes with a lot more insights on this. He's represented the Italian tax authorities, the Italian government, on their views, sitting as a part of the interim report discussions. I'll just let Gianmarco about 12 to 15 minutes to cover what the interim report is all about, what were the conclusions, and where do we stand after the interim report. This is just setting a context, the primer for the panel discussion that's going to follow. Thereafter, what we'll do is we'll take up 3 case studies of prevalent businesses, big ones. What do we do? What are the issues around that? What is the panel's view? And we today have a panel which will be able to add a lot of value and a 360-degree coverage. You have Gianmarco, who can bring global experience. How is it from when you're looking at a consensus approach, OECD's view, etc. You have Hari, who will add value on what is it in India from a practitioner's perspective. Vijay Sri will bring in the business flavor to it. How does companies look at it? And Kamleshwar sir will, of course, be able to throw a lot more light about how administrators view it, and especially from India perspective. I'll just hand over the proceedings to Gianmarco for covering in the next 12 to 15 minutes what the interim report is all about and what were the conclusions or lack of conclusions there.
So very good afternoon, everyone. And first, let me thank Arun for the kind invitation to India. It's my first time, so I'm very pleased to be here with you today. I would like to share with you a little bit the insight in my former role. I was working with the Italian government, and I was not directly involved on the interim report, but in the first version of it. So I think that this is somehow the outcome of, I would say, a number of lengthy discussion and negotiations that are just, I would say, at the beginning of a process that will end up, as you heard from Jefferson this morning, in 2 years' time. I think this interim report is pretty interesting because it takes position on a number of very significant areas where disagreement exists. And also, as Ajay already mentioned, when you look at this project, you need to keep in mind that this was not created as a technical issue, but is, first of all, the outcome of a political friction or a political request that countries ask to identify an area that the consequence of which cannot be just limited to, I would say, to digital businesses, if somebody is able to say what digital is. So I think that there are a number of key takeaways. The first one being that we should not be considering to talk about only digital economy, because at least in my experience, first with the government and now with the private practice, I think it's really impossible to define or to draw a distinguishing line between what is a digital business model or what are other type of industry models that can be considered far away from this conclusion. However, I think that there are three important elements that the digitalization of businesses is bringing. First of all, it is the fact that this report acknowledges the fact that new business models exist. The key features being that one of them you might have is that you have cross-jurisdictional scale without local mass. What does this mean? It seems a very complicated expression, but at the end of the day, this definition is trying to reflect the circumstance that multinational businesses can run a business, can make money and profit in a country, in India, without being physically present there. This was something that possibly 20 or 30 years ago was not possible, but because of the development of new technology, indeed, is definitely a fact nowadays. So I would say that this very first element is strictly much intertwined and connected with the second aspect. So the fact that these new highly digitalized business models rely on intangible assets. Intangible assets can be of a different types. You can have patents, you can have trademarks, you might consider about algorithms that, however, avoid the fact of having a physical presence in a country but still be able to be present in the economic life of a jurisdiction. So intangible assets by themselves, according to this report, do not have a very much, I would say, impact insofar as you do not link with the other important aspect, that is the fact that users and data can definitely have an impact in developing also the value of the intangibles. So at the moment, when you look at these three elements and you try to translate where does the friction come, I think that there is definitely a consensus among countries that users' participation in data contribute to value creation, contribute to the generation of profits. The issue comes is to what extent, in particular, user data can be considered of significance in attributing profits or taxing rights to a country. And if I come back to the presentation to the keynote speech that Jefferson said this morning, I think that one big point of misunderstanding comes to the fact that often when we discuss about digital economy or transfer pricing in a post-BEPS world, there is an increasing reference to the notion of value creation. But if I ask any of you what value creation means in a tax sense, are you able to give me a definition? The current international tax framework does not consider value creation. You do have two principles with respect to which you allocate taxing rights. One is residence, and the other one is source. So in this post-BEPS world, and I think one of the main challenges that this interim report properly highlights will be to how to determine what flesh, what concept we can put around value creation. Obviously, these three features of highly digitalized business model all contribute to value. But then it will be up to each country to determine how much profitability or taxing rights you're going to attribute to each of these, to these elements. So how this can be translated in terms of understanding the next step, how the countries will have to work based on this key report. The first challenge will be nexus. So how can I link a taxing rights to a country based on this element? And obviously, with, I would say, highly digitalized business model, if we all agree that I can have a cross-jurisdictional presence without having local mass, I might think of something else. So if you ask my personal opinion, I don't think that, in my view, makes much sense to focus on the notion of users or active users, categorization of users to attribute taxing rights to a country. Because from a pure tax standpoint, how would you be able then to attribute as an asset users to a company? I think that the current set of rules don't allow you to do that, and therefore the nexus issue brings with itself the second problem of attribution of profits. What you can definitely do as a country is instead determining the amount of investment that a company is making in a jurisdiction. So there are among certain scholars now new ideas that I found, in my opinion, pretty interesting, that can be referred to the notion of assessing the level of digital investment risk that a company can have in a country in order to allocate taxing rights. So I think it will be interesting to see how the notion of nexus will unfold in trying also to, first of all, determining how much we can consider the role of user participation as significant for attributing taxing rights. And once I have established a nexus, the second step will be how much profits I have to attribute to it. So if you allow me to just focus on the notion of user participation, at the moment, I would say the tax world can be defined, I would say, distinguished in three main groups of countries. You have a first group of countries like India, countries like Italy, that think that the notion of user participation has to be definitely considered as an element to attribute taxing rights, because these countries see a kind of misalignment between taxing rights, value creation, and the role of users in highly digitalized business models. Then there is a second group of countries that consider that indeed the notion of user participation has a significance, but pose problems that are not limited to highly digitalized business models. So these three features that you have on that box on the left are not limited to highly digitalized business model, but permeates every industry sector. And then you have a third group of countries that say, hang on a second, the BEPS project has been released at the end of 2015. Let's first see and assess what is the impact of the current rules will be in order to determine whether the system is broken or has to be fixed. So, as already Anjay mentioned, there are other BEPS measures that already can have an impact in the context of the digitalization of the economy. The first one being Action 7. When Action 1 was developed as part of the BEPS action plan, there was a significant relevance by a number of countries that certain problems could be addressed by the implementation of Action 7 that would have led to an amendment to the definition of the permanent establishment status. Obviously, for those of you who have been dealing with the current implementation of Action 7, also in the context of the OECD multilateral instrument, on top of the amendments to the definition of dependent agent permanent establishment, you have the reconsideration of activities that previously, so before the BEPS project, were deemed of auxiliary status. For example, warehousing of goods for further delivery. So everybody, I think, that have the Amazon business model in mind, but this can be something that can apply to also other type of multinationals. Action 7 also has an impact for trying to limit the situation of segregation of activities that then can also limit and avoid the existence of a permanent establishment. Then you have Action 3. Action 3 try to ensure that CFC rules, new CFC rules, can capture revenues that are generated in digital economy transaction. Obviously, CFC rules are specific anti-avoidance measures that try a little bit to be refined in order also to have this new highly digitalized business model in mind. And then it comes to action to the analysis on actions 8 to 10. And it's very interesting if you read the label of these three actions, aligning transfer pricing outcomes with value creation activities, that obviously the emphasis for highly digitalized business model was in trying to reconsider, in particular, how the arrangements around intangibles and this distinction between legal ownership of intangibles versus activities that can be labeled as DEMPI functions would then lead to the attribution of profits. Interestingly, I think in my opinion, is the fact that none of these three actions have been considered by the OECD as minimum standards. So none of these three actions are somehow under the spotlight for countries to be implemented within their own domestic provision. So obviously, I think that one important aspect is that if you look at these key takeaways of the interim report, is the fact that it is clear that work has to be done, in particularly in understanding how the role of users as a play vis-a-vis the notion of considering that intangibles generate value. But in being this a political exercise, even before than a technical exercise, no one knows what is going to be the outcome in 2 years' time of this project, because at the end of the day, here there is clearly a struggle between the countries that are trying to expand their source taxing rights versus the countries that are trying to protect instead taxation based in the country of residence. Between these two principles, you now need to consider how value creation, how the notion of value creation is going to be developed. Because frequently now countries tend to put value creation as the key justification to tackle this type of business model, but value creation is, I would say, a foggy areas that might fall within the definition of residence, but also might fall within the definition of source. Having said that, I think that one main concern that the OECD had is, please avoid countries to take unilateral measures. And interestingly enough, I come from a European country. I have to say that my country has been the first one not to listen to what the OECD has been saying, because we have introduced a very specific provision that is a levy on digital transaction that is, I would say, way wider than the equalization levy that you have in India. And I'm going to spare you the details on it. So you have, as you see, a number of countries that have played ahead. They didn't want to wait the outcome of this interim report. And I think the most dangerous thing is that if the goal of BEPS is the avoidance of double taxation or double non-taxation, what is going to be the outcome of these unilateral measures? Also because I would like to flag you the fact that the European Commission, 21st of March of 2018 of this year, has introduced a proposal for a directive where countries will be allowed to introduce an interim measure that will allow taxing companies based on a certain percentage of their turnover even. So this means that a number of provisions that would justify the application of double tax treaty relief would not apply, because simply certain countries would apply this tax on turnover rather than profits. So in this case, all the benefits of a double tax treaty would be excluded. So the outcome, where do we stand right now, is that it is technically a mess, because you have certain countries that are running on their own train, whereas the OECD is trying instead to develop a comprehensive, inclusive approach with an outcome that before 2020 will not see its light.
Thank you. So, moving ahead from these unilateral measures, I just thought, all of us are aware of this, but I'll just put it out there because this will be very relevant for what we are going to discuss and the panel discussion that's going to follow, which is what has India done on, not necessarily digital economy, but on some of the unilateral measures. This has been discussed and all of us know it, equalization levy, then there's an amendment to extend a definition of term business connection to include a significant economic presence. Now, of course, this doesn't apply to treaty countries because the treaties are intact and it applies only to non-treaty. MLI does not cover this, so at this point, significant economic presence is to non-treaty countries. Then there is also an introduction of the anti-fragmentation rule in our law, again, Article 12 for MLI, which India is a treaty, covers that There are some aspects, and one of the key one is the online information and database access of or retrieval services that's been brought under GST. These are some of the changes that India has done, and equalization levy is classic, amendment which sort of does not take into account the treaty obligations, one may say. Significant economic presence is not so. So we will just discuss each of these or some of these at least in greater detail when we get into cases. What we'll now do is get into three large case studies, not necessarily in form of companies or examples, but business models, and thereafter move on to country-specific measures and what we think on those. The moment one starts talking of digital economy and taxation of that, what really comes to our mind is again Facebook, Twitter, Instagram, and so on. These are social network companies which really provide a platform for people who are having relationships in the real world or not, but to connect up on the online world, share experiences, share pictures in some cases. These result in news feeds, these result in user-generated data, user-generated contents, which really the companies uses. Some of them charge the users, some don't, some charge for certain services, but their revenue could be advertisement. Now, in a situation like this, and if we were to stick to the concept of value creation, the question comes as to how important or significant are the users for the concept of value creation. Yamako, any views on how important or how critical users would be for a value creation in these business models?
Thank you. Well, I mean, when I had my economics professor, that was always telling me, Gianmarco, figures never lie. You know, you can develop all concepts, but figures never lie. So if you take, let's say, the 20F or 10K, so that are the normal information that companies like the one that you mentioned disclose to the Security and Exchange Commission, you will see all of these companies that will put a lot of reliance as a key metric for them to develop the number of active users. So obviously, users are a significant aspect in the supply chain of these groups. How it is important to assess them, can you consider them an asset, technically speaking, of this company? I don't think that the current set of rules nowadays would allow you to say so. So, on the other hand, in the context of a value chain of a company like Facebook or Twitter, there is a significant reliance also on intangible assets that allow these companies then to generate and to extract profitability by making use of these users. And I believe that, you know, if I look at a company, again, like Facebook, for example, in my country. Facebook, obviously, I heard the comments from the prior panel that was saying, yes, but, you know, the fact that I'm having access to my Facebook account, it doesn't mean that I'm paying to have access to this account. Of course you are paying, because Facebook is providing you a service that is getting access to this platform. What you don't know as a user is the fact, and I think Mark Zuckerberg was, I think for a number of reasons, had to go all around the world to explain how Facebook was making use of this data. Then how can I consider this to allow the country where these data are collected to tax the business profits? I think that these companies are right at the moment in challenging the fact that they say, look, one thing is what the tax legislation is saying, another thing is morality. So obviously, BEPS, in my opinion, bring this discussion to the level where morality is part of, I would say, shaping tax legislation. Data obviously contribute to the generation of value for a company like Facebook or Twitter, but they cannot be the sole element to attribute profitability or taxing rights. I believe that one of the, if we come back to the interim report, in this case, in this model, you already, the current set of rules that the OECD has been developing in Action 8 to 10 would allow you already to try to tax a little bit of the profits that Facebook generates in a source country by selecting, for example, appropriate transfer pricing methodology. And in my experience, companies like Facebook or Twitter, they are always physically present for tax purposes. I assume that Facebook will have a company in India, as they have it in Italy or in a number of European countries. So as long as you apply the current set of rules, you will be able to properly make a framework of what is the current value generating mechanism.
Thank you. Hari, Jemako said that Facebook would be present in some form and there would be users, and that's not the sole criteria for deciding where the value creation is. Now, two things. One is, of course, they'll have companies, and how important is what that presence is. And we were discussing about the Google case in the previous discussion, and where the question was if the company present here performs multiple functions, all of them are in one entity. So how do you determine what does Facebook in India, the presence that they have, do, and how important is that, one? And number two, the way I look at it, and if I listen to the arguments to say that data or user presence is not important because they're not paying, I may today not be paying for Facebook or Twitter or WhatsApp to be there. But if India didn't have the hundreds of millions of users that Facebook has or Twitter had, would anybody advertise on Facebook and Twitter? And would their advertisement revenues really be at the level that they are? And is some of that attributable to the free users in India?
Let me start with the second point. I think there's a fundamental point that we're all missing. I mean, when I'm using Facebook, it's true that I don't give them cash, but I am sharing my data. I am giving them the list of my cousins, the name of my wife, the place where I went to school, the house that I bought. I mean, there's a lot of information there. To some extent, maybe, I don't know if it's really in the nature of a barter, but someone could easily argue that it is. And coming to the relevance of that information, it's very easy for us to look at a Facebook or a Twitter and start imagining that data as a concept came into existence only now, and it's only now that it has value. But let's not forget that even before, 30 years back, a biscuit company selling biscuits to customers in India did have some information about what the market is, what preferences are, what regions have what preferences, and so on. It's just that at that time, because it was sort of subsumed within what we'd normally fall within the concept of market research, internationally we realized that there isn't really much point in attributing value to it, or creating a taxable nexus, or having all sorts of tax consequences flow from that data. In the context of Twitter, it's very easy to say, oh, there's a lot of users in India, and therefore it makes sense for us to tax them. But when we talk about neutrality, and this is again coming back to the point of the difference between a digital economy and a world that is increasingly digitalized, how easy it is going to be? Is it going to be for us to say that these rules will apply only qua Facebook and a Twitter, and not to any other company, a bricks and mortar company that uses data? And then if we are going to go down that path, what we're looking at is not really trying and solving a specific problem that's limited to Action 1 of the BEPS report, but really rewriting the entire way in which we are taxing companies that operate globally. And I think that's something that we need to keep in mind as we discuss this. I mean, today it's fine, we're talking about Twitter and Facebook and Instagram and whatnot, but the same principles can very easily be extended to other things. And the whole concept of the presence in India, and I think that's a bit of a red herring. A Facebook might have a company in India, it might have a branch, but I don't think the real issue is what is the functions that those branches do, what are the activities that are done there, what is the income attributable to that, does it constitute a P? I think all that is a sideshow. The real question is relating to where does its value come from, and if it is data, we can have data as a means of value creation and as a means of taxing a particular country, but we should keep in mind the fact that it can very easily be extended to other businesses as well.
Thanks, Hari. Mr. Vashni, I was listening to some of the comments that you were making, and you had some very clear thoughts on what this user data would be. And one thing that just came to my mind is, are the administrators today, and are we looking at customer is king in a completely different context to say that if there are users, and I don't know if I as a user of Facebook am the customer or is the advertiser or who, but is it so important, and what's your view on that, the point that Hari was making, that data is available, or what Jemako was telling, that can't be the only aspect. if there are presence in India, if there are customers in India, and how would you look at it in terms of profits being attributed to India and taxability here?
See, there are two issues. One is of significant economic presence, and one is of value creation because of data or users in India. Now, these are two different things. So let's talk about first data. So right now we agree that there is no international consensus that whether we have to attribute some profit to the users, where the users are residing, where the data is generated. So far as India is concerned, along with like-minded countries like Italy and all, in international forum, they have a view which they are expressing that the earlier models have not been able to capture this aspect, that there has to be some attribution to data also and value creation. And this is what I had said, that when you collect a raw data, some companies are collecting raw data from India. Now that raw data has a value. And therefore, if there has to be an attribution at that point of time, some consideration must be given to that raw data. Maybe I fully agree that, you can't say that, if in the entire value chain which was presented in the previous session, so whatever amount can be attributed to that raw data. Now, same thing, like what was said last time, that in the last session, that Facebook has advertising revenue, but very little advertising revenue from India. But I think that point was also spoken here in this panel. But okay, fine. How are you looking at Facebook advertising revenue? Only because European countries or American companies are advertising, but they are advertising because of Indian users, because Indian users are able to see those advertisements. And once again, if they collect the data about Indian users, they may be selling it to European companies or to American companies. That does not mean that there is no generation of, there is no value from the data which is being generated from India. That is not the correct way to look at it. So idea is that yes, there is, we have to give consideration because of this digital economy, digitalization. There is a consideration has to be given for data and users. How that is to be given, that probably we will see in 2020 or whenever this final report is coming, whether there is going to be a consensus or not. And I think a very important point here, that what other countries are doing, that they are coming out with interim measures, whether it is India, Italy, France, Hungary, and all other countries. Now, it is like the example which was given in the morning by Arun, that Messi is under pressure. So he had given that example that just like OECD is under pressure to come out with that final report by 2020, and he had taken that example of Messi. Now, if you remember, the debate is going on in the sports world that who is GOAT. So I know most of you know the meaning of GOAT, but in sports parlance, GOAT means greatest of all time. So there is a debate going on so far as soccer is concerned, whether it is Messi or whether it is Ronaldo. So last month, a sports magazine came out with Messi with a GOAT in the front cover. Actual GOAT, I mean, in his hand. So that probably infuriated Ronaldo. So if you watch that what is happening in football matches, every time Ronaldo scores a goal, he goes to the sideline and does this. So basically, so Messi is under pressure from everywhere, including Ronaldo. So what Ronaldo is doing is actually all these countries, India, Italy, France, are doing, and they are coming out with interim measures to put pressure on OECD, to put pressure on other countries, that they should come out. If you want to be a GOAT, then you should come out with a final solution.
Thanks, sir. That was very well put. Now, we thought we'll choose 3 case studies which will highlight each of the 3 problems which were identified in the interim report. We've sort of discussed, deliberated on importance of data and user participation. We'll next move on to the second one, which is business models which have heavy reliance on intangible assets. And one thing that comes to the top of my mind is marketplaces, which really are dependent on intangibles, IPs, because of the apps, the algorithms, the computer software that they have. Vijayashree, any views on these marketplace models? And I'm sure you'll cover what those business models entail and what issues arise in those.
Yeah, thank you. So the so-called ride for hire kind of companies, which we have today, like Uber, etc. So the way they operate is they do have a platform. That's the IT platform that they work on, and they recruit drivers in the local jurisdiction. And the IT platform basically kind of matches the customers' data. That here there are two types of customers in the jurisdiction, which is non-commercial, which is the driver, and the commercial, which is the customer, who's the end user. And they match that data, and those algorithms kind of come to a analysis about what is the demand in that market, and that demand kind of also helps in determining the price in the local jurisdiction. So this kind of platform which they have, where there is an IT kind of intangible being created offshore, preferably in a non-tax, low-tax jurisdiction, and you have a low-tax jurisdiction where, you have a local jurisdiction where you have the customer base and the users, and you're using that data for kind of building that platform or creating that platform. So in this kind of analysis, so the question arises is where are the intangibles and where is the value creation? Again, it goes back to that question, whether you are kind of creating that value offshore in the offshore location, is that the value creator, and is that the IP kind of hub there, or the local jurisdiction where you are using that critical user data and the history that is being created in the database that is being created, that is critical for the analytics and also for determining the price in the local jurisdiction. So this is a kind of issue that is being grappled with, and today of course 8 to 10 action plan is kind of goes to say that, yeah, you have to kind of have a model where you kind of link your value creation with the transfer pricing model and kind of give an appropriate return where the significant economic activities are being performed. But the question remains is that all, or is there a value created even in the local jurisdiction where actually the users are, and kind of where the customer is kind of completing a ride, and the actual data is being used for the analytics. So that's one question that's been debated, and how much of that should be attributed is also a very critical question. So out of the DEMPI functions that we talk about today, the exploitation bit is happening in the local jurisdiction. So but then what is the attribution to that exploitation is also a very critical question that needs to be kind of come out, and I mean it's not there in the existing rules, and we need to kind of get answers to that as a business.
Thanks. So, Jimanko, one, just taking on from where Vijayashree left, and this is if we were looking at the Ubers and the Olas, and today you have Uber operating everywhere, Ola going into Australia, and Ola happens to be an Indian company which is competing with Uber here, and they've now gone into Australia. She talked of the business model of drivers, local connect. It's more of a service, ride service that is being provided. Would anything change in terms of what we just heard in, say, a model like a Airbnb, where the customers actually could be in a different country, but there's actually a physical asset in form of the house or the property which is being rented out through this app, marketplace model, whatever you could call, technologically linking the two. And you could have a situation where the owner of the property also happens to be in a third jurisdiction, and the person who's renting happens to be in a fourth jurisdiction, and the house or the property happens to be elsewhere, and Airbnb as a company operates out of the first jurisdiction. Would some of these apply in those cases, or should we be looking at completely different models even within these different business models? How would we ever come up with rules that apply across these kind of business models? Are businesses evolving so much that the same rules may not apply to everybody?
I think that's the main concern of companies, that you do not have a consistent approach in jurisdiction. I mean, if I look, for example, at the case you were describing of Airbnb or the case of Uber, if you look at when you, I don't know if you ever rented a house in Uber, and you go and you read the description of the business model of Uber, they are a market online intermediary platform, the same way as Uber is. Because in your example, if I am an Italian citizen resident in Rome and I own an apartment in Amsterdam, and there is a customer from India that wants to rent out my apartment, Airbnb, what's the role of Airbnb? The role of Airbnb will be to link the potential customer with me, but the asset is not the house, the apartment is not an asset of Airbnb. I think that the whole discussion that we are having right now about the digital economy is a little bit, but this is just my personal opinion, okay? A little bit misinformed, because people nowadays in 2018 are mobile. So talking about people and presence is a concept that nowadays is at odds in the way where people live. So if I look at the way multinationals run their businesses, I think it would be much more interesting in this example to know how much investment is Airbnb doing in a certain country to provide that service. For example, if you have Airbnb providing you a service in India, how much money Airbnb is spending to translate his language in India? How much money Airbnb is directing to advertising its services in India, and so on. But focusing on simply on the notion of user is okay. It's a concept if we are saying that, okay, I am tired, I am fed up with the fact that I cannot tax enough these profits. If this is the conclusion, then we need to reconsider it. But if we try to force, according to the current set of rules, to say Airbnb has to pay more taxes in its country where it has its customers, is, I think, a little bit stretching too much the current set of rules and going beyond them.
We'll just move on to the third problem that was identified, which was on cross-jurisdictional scale without a local mass. And the first thing that sort of comes to my mind is a reseller entity, a Amazon, a Flipkart, and of course Flipkart was here, Alibaba, or anybody like that, which basically what they do would be to resell goods purchased from a supplier to a final customer, could be with a markup, could be with a service charge, could be with added service offerings, either in form of logistics or whatever. And in a lot of these cases, the goods could either be tangible, could be books, could be anything, could be a water bottle, or it could be intangibles of downloading of the same ebooks, music, etc. So what typically would happen is a customer in any location would visit a website, place an order on the website for a particular item, and that could potentially be supplied by a supplier, by a manufacturer, by another distributor, but really the marketplace entity or the reseller entity in either of the cases would really act as a bridge between the two to fulfill that commitment, fulfill that order, and then also provide certain logistics. There could be situations where these companies have local subsidiaries which do that last mile of logistics, or they could use a third-party logistics service provider. Now, in all of these, how would a significant economic presence, what would happen in the new concepts that we are discussing in a reseller or a marketplace platform? Sir, your views on this, it could be, I'm just taking names so that we'll be able to relate to the example like an Amazon or a Flipkart or a Alibaba. What would your views be on what happens?
Yes, exactly. See, now we, move away from the data and come to the second aspect, that is significant economic presence. And why this concept is being introduced is because let us try to understand the concept of permanent establishment. When it was introduced many years ago, the question was that if you have to allocate profit between resident country and the source country, then there must be a permanent establishment in the source country, because if there is no permanent establishment, the activity in source country will be so less that it would be meaningless to attribute any profit. The cost associated with attributing profit for very small activity in the source country would be much higher than the revenue that country will get. That was a concept of permanent establishment. So PE is not an end itself. It was only a means to achieve the end, that is allocation of profit between two countries. But now you cannot say the same thing. With the advent of digital economy, even without a physical presence, a lot of activities can take place in the source country. And that is where Professor Rohatgi, he's not here, but the point he has made was a very important point, that if without physical presence, thousands of crores of sales are happening in India, then who has created that infrastructure? Who has educated the people in India? Who has given money power in the hands of those people in India? It is the Indian government. And therefore, Indian government has a right to have its share of taxes. But the old concept of permanent establishment is saying that you can't have a right to tax. It is where all these countries are asserting their right that now we need to have a relook at this concept of permanent establishment. And that is the reason behind this significant economic presence. And therefore, this amendment which was introduced by the government, of course, it is not applicable to tax treaties, but this is definitely one way out of giving right to the source country in such kind of transactions. Of course, it has to be accepted at a global level in the inclusive framework, and further attribution rules have to be defined. But this is a starting step. So significant economic presence, the reason of this concept is just what I have told you. And obviously, there's still some distance to go before it can be put to practice.
Thank you, sir. Hari, you a while back you did mention that possibly digital economy or these companies and these business models are just a door to open, and we may need to revisit a lot of things in international tax, allocation of profits, etc. Now, having heard, there are no conclusions even here, but having heard what you have heard on whether it is importance of user data, a physical presence, or reliance on intangibles, etc. What's your view on where do you see this going? Do we really see a need or a requirement to rewrite everything that we've been doing, or can it be done with minor tweaks and changes here and there, and small amendments, inclusion of certain things, exclusion of expansion of a definition, or do we need to revisit all of the things that we've been practicing so far on international taxes and allocation of profits?
I think what we're really talking about is the process. I think it's inevitable that we will see a large-scale change in the way we tax everything. We might start off because we believe that the case of Facebook or Twitter is so outrageous that we need to tax it, or else we are being shortchanged. But I mean, what we are ultimately legislating is a principle. We are saying that, what they're doing here triggers a taxable presence. It ought to give rise to some revenues for the Indian government. But I think the logical basis on which what we are doing and what we are trying to do in the digital economy will at some point lead to a full rewriting of the way things operate. Because I mean, the central premise of what the OECD is doing and what everyone has been saying all around is there is no such thing as the digital economy that exists independently of everything else. And the moment we acknowledge that, we may start off with things that are driven by specific industries, but in the long run, I think it's inevitable that we may see something very, very radically different.
Thanks, Hari. Gianmarco, now, sir was talking of a nice example of pressure on Messi for GOAT. Now, whether that pressure on Messi by the Ronaldos and the Neymars of the world are because they want to put pressure on Messi, or whether it is they want to be the GOAT. I don't know which of the two it is. But in that context, do you really think that the Ronaldos and the Neymars have been actually able to put pressure on Messi with all the interim measures that they have done, unilateral things that they have done? What do you think has happened, and what does this unilateral measures do? And has it achieved at least the objectives that the country sought that they wanted to?
I think it's a very mean question because, Italy, for the first time after 68 years, we didn't go to the World Cup. So I think it's very difficult to answer this question, but I'll try. So I think the Ronaldos or the Neymar or all the countries that have taken unilateral measures, I don't think that they are, I don't think in the short run, I think that they are trying to achieve, I think, what is their goal in order to push the OECD a little bit on the corner. I also think that each of these countries, I can speak for my country, for Italy, I think the discussion on the digitalization of the economy has became a matter of political campaign. So oftentimes, these kind of countries, I'm thinking also about Israel, I'm thinking about Hungary, I'm thinking about the UK and Australia with the diverted profit tax that were somehow forced, even if, although technically they were not that convinced to introduce such measures. I think that it's too early to say whether or not they have achieved their goal. I read, I think last month, there were some statistics that the UK released that they were able to recollect 150 million euros pounds from the application of diverted profit tax. If you ask whether this is the right solution, I personally don't think so, because at the end of the day, we need to think also where we started from. If the start is BEPS is primarily avoiding double non-taxation, is also try to eliminate double taxation. And if you speak with all the multinationals that are in this room, at least the one that I speak with in Italy or abroad, oftentimes the answer is the same. We don't care where we pay taxes as long as we pay once. So now, how this is going to be the outcome, I don't think that this is going to be very, very helpful.
No, I would tend to agree with that, and probably in this pressure game between the Ronaldos, Neymars, and Messis, I'm sure the spectators are not enjoying, which is really the taxpayers. And I would come to you on that, Vijayashree. Whether it is back home here on equalization levy, what does that mean to companies like yours? Or what do unilateral measures mean on tax rate, double taxation, administrative difficulties, if you could just... From where you see as a, as a tax head of a multinational presence in India, what would that mean to you?
I mean, I kind of agree that now we kind of have to, because of those unilateral measures, we have to keep kind of keeping a track on wherever we have business operations and what are those interim measures, what are the compliances that need to follow, and what are the TP policy changes we need to do, what are the changes within the multinational organization we need to do, kind of change in the structure to kind of fit into that, the way the tax authorities approach have been. So this is kind of getting into, rather than or we may have to wait and see till 2020 on how the consensus has been. So that might be more interesting to see how the consensus, rather than, it is kind of inconvenience to the multinational businesses like ours to keep a track and kind of getting those compliances in place. So it's a kind of we are very anxious about every day you see an equalization levy or a significant economic presence, then and we are kind of wary about what next. Rather than, if it's a one consensus, then we could kind of build a model where we can align our transfer pricing policies in line with those measures or international tax rules. So that's a major concern for us.
Sir, you were, while we were discussing, making a very interesting point to say that MLI, the way it is structured and the way it would come, is that countries may now not be able to choose what they would want to do with another party, and earlier you could negotiate a treaty with a particular country in a particular manner, another country in another manner, looking at what works for you, source, residence, and then accordingly choose, depending on which business, what you want to target. Now, the way I was looking at it, and Gianmarco has mentioned it once or twice, and Hari has also alluded to it, to say that there is a political undertone to some of the things that's happening on taxes, whether it is for negotiations, whether it is to get somebody to agree to a consensus, etc. The point that you made was very interesting, to say once countries start aligning to MLI, then your position on certain aspects cannot be chosen vis-a-vis the other countries, and it would be uniform. Do you think that is probably one step towards the problem that Vijayashree highlighted, to say that unilateral measures do create tax leakages, double taxation, non-credits, etc.?
Yeah, see, first of all, I fully agree that unilateral measures are certainly not good for the taxpayers. And India has made it very clear that equalization levy that India has imposed is only a temporary measures. And once we have a consensus, that it will not be there. Having said that, I will say that equalization levy, it is certainly not good for the taxpayer, but the kind of beat which US has introduced has actually challenged arm's length principle. So it is not going to that extent. But yes, we do agree that there has to be a consensus, and India is willing to contribute to arrive at that consensus by 2020 so that uniform solution can be found and which is acceptable to all, and businesses do not suffer double taxation. So one idea which I had discussed with Ajay was that, this MLI is a very good concept. It is really a very good thing which OECD has come out with. So basically what is there in MLI is that you take a position, and that position cannot be country specific. You cannot say that, with country A, I will go with this position, with country B, I will not go with this position. I mean, and I'm talking about the areas which are not mandatory. So those who are mandatory, I mean, everybody has to agree. But those which are not mandatory is either you take a position, yes or no. If you go for it, you go for all the countries who have said yes. So you can't say that, with one country I will go, another country I will not go. So this probably could also be a one, step forward, that can we amend tax treaties through MLI, including significant presence test. That means even without physical presence, PE can be created if there is a significant economic presence. And that, can be a way forward in the sense to start with. At least the countries who are willing to do it can start doing it. Of course, that will not solve the problem completely, because a country like USA will still say no to everybody, and a country like Sweden also will say no to everybody. So that will not solve the problem of source country completely, but at least it will have some beginning to start with. So that is what I was just sharing with Ajay.
Thank you, sir. So, to wind up and final remark, concluding remark from, I would request all four of you to give your personal views on, do we really see this consensus happening, or is it a pipe dream? Where do you see it? And we can only crystal balls gaze this, but what is your view? Are we getting there? Will we get there? And same thing for all the three of you.
Jefferson, what do you think? Are we getting there or not? Well, I think that at the moment, the position among certain countries are way too distant to say that a full consensus will be achieved. Maybe a solution could be, and this is something that I always wondered why it never happened, also during my time at the OECD, is that if consensus cannot be achieved, I think it would be very important for taxpayers to know what, in the form of observations or reservation to a final report, what the position of each country will be. Because at the end of the day, the goal should be just to get consistency. If consistency is not possible, then focus on clarity. I think that would be the main goal in mind. Because particularly the role of data and the role of users is, there is too much friction at the moment among countries, even within the single country, in order to provide an accurate answer.
Thank you. Adi?
I think I agree with what Gianmarco said. I mean, there are still too many open areas, and when we look at the Indian law itself, I mean, unilateral measures, I mean, as uncomfortable as they are, and I mean, we may rely on them reluctantly, but I mean, we have serious gaps in domestic law as well. I mean, attribution of profits to a significant economic presence is completely left open, and there's a need for, I mean, there's a real urgency that something develops quickly at the OECD, or else these so-called temporary measures may balloon into something that may make it very, very difficult for taxpayers.
I too agree, and a consensus is the need of the day. I mean, for taxpayers like us, we need to get there, and with the objective of course, double taxation and avoiding that double taxation, because that's the major issue that we're grappling with, and not getting credits, etc. So I would think yes, consensus is the need and the requirement.
Yeah, absolutely. There is no two-way that consensus is required. In fact, I have already given my views. I will just like to add that whatever views I have expressed are totally my personal view and does not represent the view of the Indian government.
Jeff, can I take the liberty of, asking your views on this whole important aspect? I think there is unanimity here that consensus is the need of the hour, and Hari went on to say that it's urgently needed.
goal. Thank you. When the countries come to the OECD meetings, they're coming with a good faith intention to reach some kind of an agreement if they can. Unfortunately, it may result in an agreement on something high level which is not terribly specific, which is maybe inevitable in the world of income taxation, where it's fact-based, it's case by case. You can't often make sweeping, simple, general rules that work in every taxpayer's case fairly, et cetera. So, you know, I think we'll be working towards something that may end up, at least in the 2-year time frame, as a fairly general statement that everybody can sign up to, which is very high level. And then people will continue, I think, to drill down and try to get more specific and have revised or more elaborated and more specific guidance as we go along. But it's not, there's not going to be some silver bullet or magic solution to this. I think it'll be just an iterative process where everybody continues to soldier along and working toward the tax nirvana.
Thank you. I'd like to thank all the panelists for what appeared to be a very engaging discussion and for all the views shared. Thank you so much. Thank you, sir.